Hi, everybody. This is Sandate, Head of Capital Markets with Nectar. I'm really excited to kick off this interview spotlight series with our first guest, Mike Dowdall, who is with Alternative Fund Advisors. Mike, thanks for joining us today on this spotlight. Tell us who you are and about your firm.
Great. Yeah, thanks, Andres. Great to be here with you. So AFA, Alternative Fund Advisors, really our goal is to bring what we consider to be institutional quality alternative assets to primarily the registered investment space, so the RIA space. A lot of these are independents, as well as the family office space as well. And so what's happened is that private assets for so many years has just been this institutional market, and really is these large pensions, endowments, foundations. And it's been very, very hard for these other investors to access it. So we believe that through certain access vehicles, the vehicle we use is what's called an interval fund. It makes it significantly easier for the rest of the market to access what we consider to be true alternatives.
Yeah, that's exciting. I'm looking forward to learning more about AFA and your platform. Can you tell us about the private credit space? This is an area that's just been booming, over the last decade. It's becoming, some say, like an alternative to fixed income or a way for investors to generate yield in their portfolio. So how do you, Mike, and AFA think about the sort of broad term private credit?
Yeah, and it's interesting on private credit, everyone has their own definition. When you look at the broader private credit market, most of the strategies you see are what we call middle market direct lending. And so what that means is when a private equity firm typically goes and buys just an individual company, they need to finance it. So they're not going to put up all of their equity to buy it. They're also going to take on loans. And those loans are really the collateral and the main part of the asset class right now. We think that those middle market direct loans, they're fine. We think that they're a good asset. We think that that's just only one small part of this broader private credit ecosystem that investors should have access to. So we look really across the wide swath of strategies and different types of loans, and we try to find where the best risk reward resides. And so when we're looking at it, it can range from things like consumer loans, and one of the big trends is like buy now, pay later loans like that. So that's on one side, and then all the way up through things like loans to businesses that are like asset-based loans. So maybe they use their inventory as collateral and they get loans off of those. So there's just this huge market, and it's very fragmented still, and we think that provides great opportunity.
Yeah, I would imagine. So Mike, maybe you can talk a little bit about your role at AFA. So you talked about this broad spectrum of call it credit strategies. We're not talking about the land of, sort of Moody's and S&P rated bonds here, right? So how do you put call it a framework around the things that you look at AFA?
Sure. Yeah. So we manage the AFA Multi-Manager Credit Fund, and so that it's an interval fund, and so we have a lot of leeway in terms of what we can invest in. What we do is we take a multi-manager approach, and what we look for in particular are small to medium-sized lenders, essentially, that have niches within the market. So they might be what we consider to be the best lender to one of the groups that were in there before just did healthcare and small to medium-sized healthcare entities, bridge loans to commercial real estate, things like that. And that's really what we're looking for. In terms of the framework for when we look at the market and kind of funnel it down, the way that we break it out right now is we have basically there's specialty lending. And specialty lending can be a lot of things, as I mentioned before. So it can be real estate loans, it can be loans to businesses, consumers. There's a lot within there. But what we always want to see within that space are groups that are lending and they have some sort of, call it a sourcing premium, where they're able to, they have connections within the market, they understand their market better than others, we believe. So they're able to originate loans at what we consider to be extremely attractive risk rewards, particularly compared to the rest of particularly the public credit markets. So there's that specialty finance portion of the market. There's also what would be considered that middle market direct lending portion of the market. And then there's all this other that's kind of quasi-private credit, like what we consider to be more tradable credit. And so that would be things like structured credit, CLOs, CMBS. Some consider that private credit. I think that's probably up for debate. You'd probably say it's not as much, but that still is probably within that ecosystem as well.
So if I'm a high net worth investor and I'm talking to, my advisor, and he or she brings up the idea of getting alternative credit exposure, private credit exposure, what questions should I be asking, my advisor? What are the things that, as an investor that's maybe looking to allocate into private credit, what are the questions I should be thinking about?
Yeah, I think first and foremost, what you should be thinking about is, what are the risks? What am I financing, and what are the risks behind that? Within private credit, the large risk that's always out there is recession risk. Private credit, if you look at a return stream, it might just look like a very nice line up. And so you need to think a little bit more about what actually are the risks that I'm taking on. And what are the mitigants as well? So think through and ask your advisor, what are they, and how has the manager or the strategy that they're looking at managed those risks? The way that we like to manage those risks within our portfolio in particular are around many of these asset-based lending strategies that have assets underneath them. And so they're not just fully financing. So again, think about real estate. That's kind of the easy one to think about. If there's a real estate project that's worth $10 million, the strategies that we're investing in, the loans that underlie our portfolio, are not going to lend $10 million. They'll lend with some sort of a loan to value ratio of, say, $6 million. Maybe they'll give them a loan there. That's just one example. So really think about those risks. Think about how the manager is managing those risks, and make sure you understand that.
Sure. Let's switch gears and talk about trends. So, we've seen this proliferation in credit. Why has the credit boom, if you will, or the private credit boom, why has that happened? What's driving this?
Yeah, I mean, it truly has been a boom. I mean, I think that's a great way of putting it. It's grown significantly. So you can look at this, the supply side and the demand side. The demand side is probably not hard to understand if you're an investor out there. Years of zero interest rates obviously were higher now, but not significantly higher. But that financial repression has definitely caused people to start to look outside of, say, traditional markets to pick up some yield. And that's a natural evolution, and that makes total sense as to why that would occur. So that's the demand side, is really driven by those low rates. On the supply side, I think that's actually more interesting than the supply side. So what's happened is that a lot of these private credit strategies used to be housed within banks. And what's happened over the last few decades, and it was only accelerated post-financial crisis, is that there's been bank consolidation. So a lot of these smaller banks that might have been lending to maybe regional businesses or to a real estate developer, a lot of those businesses have gone, or a lot of the banks have really been gobbled up by the big guys. The second thing that really goes hand in hand is the fact that the average loan size of these banks has gotten larger and larger. And again, that makes sense. If you think about all of the regulatory burdens, how much it costs in compliance, it's hard to create a scalable bank when you're taking small loans. It's much more profitable to do larger loans because they need to go through all the credit committees, and you need to make sure you're doing know your client, things like that. So you've got these banks that have really stepped back from a lot of these niches in the market. And what's happened is that that's created a lot of opportunities in the private credit market for those that know the industries and the businesses that they're lending into. So a lot of the groups that we invest with, they used to be within banks. And so they've rolled out and they're doing very similar loans to what they used to do within banks, but they're just doing it in the private credit market now. So it's really not that much of a change in really the function of the loans as much as it's a change of where the loans are actually coming from.
Sure. I won't ask you to look into your crystal ball, and obviously we're not giving investment advice here, but I would like to get your thoughts on kind of the current environment. So we're seeing an uptick in interest rates. The Fed's raised rates, and they're signaling that they likely will continue to raise rates to combat inflation. We're seeing high inflation. People are experiencing that. So what do these two things mean for private credit?
Yeah, it's an interesting time. I think we've many of us have spent most of our careers in this deflationary environment, and it's really shifted on its head. And I think that that's something that you really need to look back at history and in terms of what's happened before, and get a sense of really where the risks lie. So just from the inflation front, and then I'll get maybe into the economic implications. But inflation, it's clear that the Fed is very worried about inflation. They're behind the eight ball, and they, at a minimum, at least want to show their credibility. So rates are going to keep moving up on the front end until something really breaks. I think is really the expectation, and so that's what you need to be ready for. So from that standpoint, you need to be ready for a high inflationary environment with a Fed that's really not going to step in and necessarily come and swoop in and help you out like they did during COVID, post-financial crisis, really many of the other crises that we've had over the last few years. So inflation moving up. From a private credit standpoint, that by itself is actually a relatively good environment, because if you're financing a lot of real assets, whether it be real estate or machinery from a business or otherwise, when inflation is moving up, it just means that your credit worthiness is getting better as well, because those assets mechanically should be moving up in price as well. So we actually don't mind that at all, having that inflationary environment. The other thing as well is in private credit, the loans tend to be short duration and or they tend to be floating rate in nature. So from that standpoint, again, the inflation moving up, your real return should be okay if the Fed's also raising rates, because that's going to increase your floating rate coupon. On the economic front, that's what definitely concerns us more, is what could happen. And really, if the Fed is really if they really do want to enter a recession, they can do that. They can easily do that by continuing to raise rates. So that's something that we stress test our portfolio, and we want to make sure that those loan to value ratios that asset managers are underwriting to hold up in those recessionary environments. Now, there's no bulletproof strategies out there. There's nothing that's a guarantee, but we think that the conservative underwriting within a lot of private credit should help it out in a lot of scenarios.
And you talked about this earlier with the strategy at AFA. You're building a diversified interval fund. So I would assume maybe you could talk about that, like to get the diversification. How are you making that decision? Because then you're not exposed to just real estate loans or just middle market loans. Maybe you could talk about that.
Sure. Yeah. So we definitely believe in diversification from our standpoint, and when someone invests in us, that's one thing they're looking for, is diversification within that private credit market. So yes, we look at the underlying collateral of the loans, and we want diversification there. That's really first and foremost what we're looking for. The second thing around diversification is the idea that each of the individual strategies that we invest into, they're their own standalone business. So these are private credit managers that are underwriting their own loans, originating them, oftentimes servicing these loans. So from that standpoint, we also like to be able to diversify that as well, because these are, it's not like investing into a bunch of different, say, mutual funds. These are truly standalone businesses. So that's another thing that we look to diversify as well within our portfolio. Just to make sure that that we're getting that there's minimal specific risk is the
Yeah.
best way to think about it from a more traditional portfolio framework.
The third piece that I'd love to hear about is you spend a lot of time doing your due diligence and doing research on different strategies, different fund managers and their platforms. Could you talk a little bit about what goes into your kind of identification and screening and selection process?
Yeah, so really it starts, you know, the old funnel. I'm not a sales guy, but I can talk the language sometimes. But you start
Yeah.
with the funnel, and what we're looking for first and foremost are groups that have a unique sourcing advantage. So we want to find groups that, for whatever reason, like I mentioned before, it's basically about connections within the industry. It's about knowing certain segments of the market better than others, being able to structure loans in ways that others can't. Whatever it is, that's the you know, fills that secret sauce. That's what we're looking for. So the sourcing advantage is the primary filter that we look for. Then we're looking at really what are the return expectations. Risk is huge. What are the risks within the strategy? Are there any specific risks? Is it more broader economic risk? Things of that nature. And then also we partner with our partner in the fund, Aon, which is one of the largest pension consultants, to talk through all of that along with the operational aspect of it. Again, these are groups running businesses. And so we need to make sure that those businesses stand the test of time. They don't have cracks in them. They're operating under best practices. So that's another part of the funnel as well. And then once you get there, you'd be surprised. I mean, that takes out a lot of the universe.
Right.
So, and once you get there, you're kind of stuck. You've got these groups that we really believe add a lot of value within the private credit space.
How do you, on one hand, do the due diligence and the sourcing, look for those advantages that you outlined, but on the other hand, you know, I would assume from a competitive standpoint, you want to find those managers for your portfolio before they get too big, maybe, or before their strategy is institutionalized. So maybe you could talk about that before we transition to close.
Sure. And the growth that we've seen in the market, it's interesting because clearly the market's boomed and it's exploded. But where's that money gone? It's mainly gone to these big platforms that again are doing kind of, call it middle market direct lending. And so what you've seen is this almost this blurring of public credit and private credit, and this gray area that's really come about recently. And so from our standpoint, that's fine. And a lot of groups need to deploy billions and billions of dollars. And that's very scalable. We first and foremost, we try to avoid those areas. We try to find pockets of the market that are not booming as much, that are maybe still overlooked, or for whatever reason, there are barriers to entry to get into them. So that's really what we're looking for there. In terms of the new managers, I think you're absolutely right. A lot of these strategies are not infinitely scalable by any means. You can't put billions and billions of dollars to work in some of these nichier segments of the private credit market. So from that standpoint, yeah, you need to have your finger on the pulse of the market and know who's out there really. And there's various platforms that try to connect you with manager to allocator, but really our best success far and away has just been knowing people in the industry, networking, and just being able to meet each other through that. I mean, Andres, you and I met through a friend, a mutual friend. So, yeah. It's really, we think that that's been far and away the most fruitful way of finding these strategies. They're not going to be the ones that that are going to be screaming at the tops of the mountains to allocate to us. They tend to be a little bit buried. And so
Right. Yeah, for sure. The relationship part of the business will probably never change, even with all the technology and all of the things that are happening in finance. One last question: if I'm an investor, I'm new to private credit. Never heard the term, never really looked into it. Got my bond portfolio. It's been has for a long time. Up until recently, my advisor says, "Hey, I want to, introduce you to a new asset class." What are the first, few things as an investor I should be thinking about when sort of hearing the presentation from my advisor about private credit?
Don't be intimidated when you first hear private credit. I mean, private credit can be as simple as you give me a loan. I mean, that's private credit. Private credit is just anything away from that banking channel, any loans made there. So first and foremost, I think that the asset management and finance industry likes to use jargon and things that make it sound more complicated than it is. But oftentimes it can be quite simple once you kind of get down to it and boil it down. So that's the first thing is don't be intimidated. The second thing is just talk it through with your advisor. What are the risks that I'm getting into? A lot of times it's going to have less liquidity, and you need to make sure that you can take on an illiquid investment. It doesn't mean that you need to hold it for 15, 20 years, but if for a couple of years, you might not be able to withdraw. So just understanding that as well, I think is very important. And then just make sure that that makes sense. I mean, I think that so many times there's a lot of complexity, I think, that might be added in. But boil it down. What really are they doing? They're making loans within X industry or whatever they're doing. So just give it the smell test, and I think you'd be surprised how far that gets you.
Yeah, well, obviously, as two folks in finance, we're sort of trained from the very beginning to think about risk and how do we get a return of our capital before we talk about how do we get a return on our capital. Yeah. One thing we haven't talked about is the upside of having private credit exposure, right? You talked about how inflation is eating at returns and the interest rate sort of inverse impact on the coupon. So maybe you could spend 30 seconds just talking about what is the upside in private credit? I mean, what kinds of expectations should an investor have with if everything were to go well?
Yeah, I mean, I think that we try to benchmark ourselves against some of the more liquid fixed income indices, and we're trying to we've past performance is no guarantee of future performance, but we think we can generally do as well, if not better than them. So I think that there should be a return. Right. You're taking on less liquidity, so you also should expect a higher return.
Should get compensated.
That's what we'd expect, and that's where we guide our investors toward as well. I think our compliance people would probably beat me over the head if I gave you a number. But
no, for sure. We don't have to go there, but I think the construct of you're tying up capital, it's more complex. There should be an illiquidity premium, as they call it, or a complexity premium. That's the skill of the manager, right? That exactly. You're engaging.
And it just makes sense because if you think about a large, the bond market that's out there, you've got these billions and trillions of dollars of money that's flooded in there, and it's very price insensitive, and so that the yields just stay lower than what they probably should be relative to the risk. When you go into the private credit market, you're going into certain areas of the market that are in fact capital starved. Right. And that's completely different dynamic than the public credit markets. So you can be a little bit more of a price maker rather than a price taker.
Well, this has been really, really insightful. I know we could continue on, but for the sake of today, I want to thank you, Mike. Before we wrap up, where can we learn, or where could our audience learn more about AFA, Alternative Fund Advisors?
Sure. Yeah. I'll give you the longest www. Out there. So it's alternativefundadvisors.com. You can also look us up on LinkedIn as well. We've got a LinkedIn page, so that might be easier. go ahead and follow us there. We try to put out just kind of quick pieces, just to give you an update on the broader market, private credit in particular. Yeah, that's probably the best place to follow us.
That's great. Well, Mike Dowdall from Alternative Fund Advisors, really appreciate you joining us on this Investor Spotlight. Wish you a good rest of your summer and all the best with everything that's exciting and going on at AFA.
Great. Thanks, Andres. Great speaking with you.
Thank you.